In November 1956, the British Empire ended, not through military conquest, not through revolution, through a telephone call. The United States government informed Britain that unless it withdrew from Egypt within hours, America would sell its pound holdings, veto Britain's IMF loan, and allow the British currency to collapse. Britain complied. Within 11 days, an empire that had controlled a quarter of the Earth's surface and dominated global finance for a century discovered it no longer possessed the power to make independent decisions. The collapse was sudden, but the structural failure had been building for decades. This was not an accident of history. It was the predictable outcome of specific economic mechanisms set in motion years earlier, mechanisms that are currently operating in the modern financial system. To understand how Britain's monetary system failed, it is necessary to understand how it worked when it worked. Throughout the 19th century, Britain operated the world's dominant reserve currency system. The British pound served as the global medium of exchange, the primary store of value for international reserves, and the standard for pricing commodities and debt instruments. This position was not arbitrary. It emerged from Britain's role as the world's largest creditor nation, its dominance in manufacturing and trade, and the stability provided by the gold standard. The mechanics were straightforward. When two countries traded with each other, they settled accounts in pounds. When central banks accumulated foreign reserves, they held British government bonds. When international contracts required a stable pricing mechanism, they used pound sterling. This created a self-reinforcing system. The more the world used pounds, the more liquid pound-denominated assets became. The more liquid these assets, the more attractive they were to hold. The cycle generated what economists call network effects. Britain extracted substantial benefits from this arrangement. The government could borrow at interest rates lower than its economic fundamentals alone would justify, because global demand for pound-denominated bonds exceeded what domestic conditions would produce. Britain could run persistent current account deficits without immediate consequences, because foreign holders needed pounds for their own trade operations and were willing to accumulate British liabilities. The country could print currency to fund government operations and military expenditures, knowing that global demand for pounds would absorb the additional supply without proportional inflation. This system appeared stable. Foreign governments trusted British institutions. British financial markets offered depth and liquidity unmatched anywhere else. The Bank of England maintained credibility through its commitment to gold convertibility. London operated as the center of global finance, the clearinghouse through which international capital flowed. But this system contained a fundamental vulnerability. Britain's reserve currency status was tied to its position as a creditor nation and manufacturing power. As long as Britain produced more than it consumed, exported more than it imported, and invested abroad more than it borrowed, the system could sustain itself. The pound's value reflected underlying economic strength. The vulnerability lay in what would happen if this underlying strength eroded while the reserve currency architecture remained in place. If Britain transformed from a creditor to a debtor, from a manufacturing power to a service economy, from a capital exporter to a capital importer, the reserve currency system would be operating on borrowed credibility. The structure would persist through inertia, through the world's habit of using pounds, through the convenience of existing arrangements, but it would no longer rest on a foundation of real economic power.
This is precisely what began to happen at the turn of the 20th century. By 1900, the United States had surpassed Britain as the world's largest economy. American industrial output exceeded British production. American technological innovation was advancing more rapidly than British innovation. American capital accumulation was outpacing British accumulation. Yet the pound remained the dominant reserve currency. The financial superstructure had not yet caught up with the economic foundation. British policymakers recognized this divergence. They understood that American economic power was growing faster than British power, but they also understood that financial systems change slowly. Currency networks possess enormous inertia. The world's banks, trading houses, and central banks had built their operations around the pound. Switching to a different reserve currency would require rebuilding institutional infrastructure across the entire global economy. As long as Britain maintained the appearance of stability, as long as the pound remained convertible to gold, as long as British financial institutions continued to function, the world would continue using the system that already existed. This created a dangerous dynamic. Britain's reserve currency depended on confidence. Confidence depended on the perception that Britain remained a creditor nation with a stable currency backed by economic strength. But Britain's actual economic position was weakening relative to competitors. The gap between perception and reality was growing. As long as confidence held, the system would continue to function. But confidence, once lost, would be nearly impossible to restore. The structural failure of Britain's reserve currency began with World War I. The war required financing on a scale that Britain's economy could not support through taxation alone. The government borrowed extensively, both domestically and internationally. By 1918, Britain had transformed from the world's largest creditor nation to one of the world's largest debtor nations. The country owed substantial sums to the United States, which had financed Allied war efforts. This debt represented more than an accounting liability. It represented a fundamental shift in economic power. Creditor nations possess leverage over debtor nations. They can demand policy changes as conditions for continued lending. They can threaten to withdraw funding if their interests are not accommodated. Britain, which had spent the previous century as the world's primary creditor, now found itself in the subordinate position. The United States had become Britain's creditor. This would have profound implications. The rational response would have been to adjust national strategy to match the new economic reality. Britain could have reduced military commitments, scaled back the empire, focused resources on domestic industrial modernization, and accepted a diminished but sustainable global role. This would have been economically sound. It would have allowed Britain to service its debts, rebuild its industrial base, and maintain genuine economic strength, even at a smaller scale. Britain chose a different path. In 1925, Chancellor Winston Churchill returned Britain to the gold standard at the pre-war parity. This decision meant that £1 would exchange for the same amount of gold as before the war, even though Britain's economic position had fundamentally weakened. The decision was driven by prestige rather than economic logic. British leaders believed that maintaining the pound's nominal value would preserve British status as a global financial power. They believed that a strong pound would attract international capital and demonstrate British creditworthiness. The policy had predictable effects. To maintain the artificially high value of the pound, the Bank of England was forced to keep interest rates elevated. High interest rates were necessary to attract foreign capital and prevent gold outflows. But high interest rates strangled domestic economic activity. British manufacturers, already struggling to compete with more efficient American and German producers, now faced higher borrowing costs than their foreign competitors. British exports became more expensive in foreign markets, reducing demand. Unemployment increased, economic growth stagnated. Meanwhile, government spending remained at wartime levels. Britain maintained military garrisons across the empire. The Royal Navy continued to operate as if Britain still ruled the seas unchallenged. Colonial administration consumed substantial resources. The government funded these commitments through continued borrowing. The debt burden grew larger.
This created an unsustainable dynamic. High interest rates to support the pound meant slow economic growth. Slow economic growth meant lower tax revenues. Lower tax revenues meant larger budget deficits. Larger deficits meant more borrowing. More borrowing meant more debt service costs. The cycle fed on itself. By the 1930s, the contradictions became acute. During the Great Depression, capital fled Britain as investors sought safety. Gold reserves drained from the Bank of England. To stop the outflow, the bank would have needed to raise interest rates even higher, which would have deepened the depression. In September 1931, Britain was forced to abandon the gold standard. The pound depreciated by nearly 30% within months. This should have been the moment of reckoning. The currency collapse demonstrated that Britain could no longer maintain the financial position it had held before the war. The economic foundation had shifted. Britain was no longer the world's dominant economy. It was no longer a creditor nation. It could no longer support a currency valued at pre-war levels. Yet the reserve currency system persisted. Even after the pound's devaluation, it remained one of the world's major reserve currencies. This persistence was not organic, it was enforced. Britain controlled a vast colonial empire. British administrators required colonial governments to hold their reserves in pounds, to conduct their trade in pounds, to keep their accounts at British banks. India, Australia, New Zealand, Pakistan, dozens of African and Caribbean territories had no choice but to continue using the pound. The empire had become a captive market for British currency. This arrangement disguised the underlying weakness. Britain appeared to maintain global influence because a large portion of the world was compelled to use British currency. But this was not genuine demand. It was administrative coercion. The moment these territories gained independence, they would have the option to diversify their reserves, to conduct trade in other currencies, to reduce their exposure to British economic policies. World War II accelerated the deterioration. Britain borrowed enormous sums to finance the war effort, primarily from the United States, under Lend-Lease program. By 1945, British government debt surpassed 200% of GDP. The country was, by any reasonable measure, insolvent. It survived only through American financial support. After the war, Britain faced a choice. It could accept its new status as a middle power dependent on American financial backing, reduce its global commitments accordingly, and focus on rebuilding its domestic economy. Or it could attempt to maintain the illusion of great power status by continuing to operate a global military presence and empire, despite lacking the economic foundation to support these commitments. Britain chose the illusion. Military spending remained high. The empire was maintained. Sterling was defended as a reserve currency through increasingly desperate measures. The government borrowed continuously, hoping that economic recovery would eventually allow Britain to grow its way out of debt. The structural problem was clear to anyone who examined the numbers objectively. Britain was spending more than it earned. It was consuming more than it produced. It was borrowing to finance current consumption rather than investing in productive capacity. The debt burden was growing faster than the economy. The only thing sustaining the system was confidence. the belief among foreign holders of pounds that Britain would somehow manage to service its obligations. Confidence, however, is fragile. It persists until it doesn't, and when it breaks suddenly. The cascade began in July 1956 when Egyptian President Gamal Abdel Nasser nationalized the Suez Canal. Britain's immediate response was to prepare military intervention. The canal was strategically vital for oil shipments from the Middle East to Europe. British leaders also saw the nationalization as a challenge to imperial authority that, if left unanswered, would encourage other nationalist movements throughout the empire. In October, Britain coordinated with France and Israel to launch military operations. The plan was straightforward. Israeli forces would attack Egypt, providing a pretext for British and French intervention to separate the combatants and secure the canal. The military operation succeeded tactically. British and French forces advanced. Egyptian resistance weakened. But Britain had miscalculated the economic dimension. The operation required foreign currency to purchase oil and supplies. Britain's foreign exchange reserves were already under pressure from chronic trade deficits. When the military operation began, currency traders and central banks began questioning Britain's financial stability. If Britain was willing to launch an expensive military adventure while already deeply indebted, what did that indicate about its fiscal judgment? Sterling came under immediate selling pressure. Holders of pounds attempted to exchange them for dollars or gold. The Bank of England's reserves drained rapidly, over £100 million per week. At this rate, Britain would exhaust its reserves within weeks, leaving it unable to purchase necessary imports. Britain requested emergency support from the International Monetary Fund. This was routine procedure. The IMF had been created partly to provide temporary liquidity to countries facing balance of payments difficulties. Britain, as a founding member and major economy, expected approval as a matter of course. The United States blocked the loan. President Eisenhower made American opposition clear. The Suez intervention represented exactly the kind of colonial behavior that was driving newly independent nations toward the Soviet Union. The United States wanted to position itself as the leader of the post-war order, supporting national sovereignty against old imperial powers. Allowing Britain to succeed would undermine this positioning. Eisenhower went further. The U.S. Treasury began selling pounds on foreign exchange markets, adding to the downward pressure on sterling. American officials made clear that this pressure would continue until Britain withdrew from Egypt. Britain faced a choice: continue the military operation and face currency collapse, or withdraw and receive American support for the IMF loan. The decision was made rapidly. Prime Minister Anthony Eden ordered a ceasefire on November 6th, less than 2 weeks after the operation began. Britain announced complete withdrawal from Egypt. In exchange, the United States stopped selling pounds and supported Britain's IMF application. The sequence revealed the underlying power structure. Britain possessed superior military force in the region. British troops were advancing successfully. But military force was irrelevant. Economic leverage determined the outcome. The United States, as Britain's creditor and the controller of international financial institutions, possessed veto power over British foreign policy. Britain could not sustain military operations if doing so meant losing access to foreign currency and international credit. The domestic political consequences were immediate. Eden resigned within months, his health broken and his credibility destroyed. The conservative government's approval ratings collapsed. But the deeper impact was strategic. Every government around the world observed what had happened.
Britain, despite its nuclear weapons, despite its military traditions, despite its seat on the UN Security Council, could not conduct independent foreign policy when that policy conflicted with American interests. The empire was finished as an autonomous geopolitical force. The financial consequences unfolded slowly, but equally decisive. Foreign central banks began diversifying their reserves away from sterling. If Britain could be forced to reverse its foreign policy decisions due to American financial pressure, then holding large sterling reserves meant exposing oneself to this same vulnerability. Better to hold dollars, the currency of the country that actually controlled the international financial system. The pound's share of global reserves declined steadily over the following decade. By the late 1960s, sterling accounted for less than 10% of global reserves, down from over 50% in the 1940s. The reduction was gradual, but the direction was irreversible. Britain had lost the confidence of international capital. In 1967, Britain was forced to devalue the pound again, this time by 14%. In 1976, Britain required another IMF bailout, this time with strict conditions attached, including cuts to government spending and limits on monetary growth. The creditor had become the supplicant. The irreversible moment occurred during those 11 days in November 1956, but not for the reasons typically understood. The collapse was not about the Suez Canal. It was about the exposure of Britain's financial dependency. For decades, Britain had maintained the appearance of power through control of a reserve currency. This control provided access to credit, allowed persistent trade deficits, and funded military operations beyond what Britain's domestic economy could support. The system functioned as long as creditors believed Britain would service its debts and maintain the pound's value. Suez destroyed that belief. Britain demonstrated that it would launch military operations without considering the financial consequences. It showed that British leadership prioritized imperial prestige over fiscal stability. It revealed that Britain could not fund its military commitments without American support. Once this became clear, the logical response for any rational holder of pounds was to reduce exposure. Not immediately, sterling remained useful for trade, but gradually, systematically, irreversibly. The confidence that sustains a reserve currency is difficult to restore once lost. The British government understood what had happened. Internal Treasury documents from the period show officials recognized that reserve currency status was ending. They knew that foreign central banks would diversify away from sterling. They knew that Britain would need to shrink its international commitments to match its actual economic capacity. But understanding and accepting are different. British leaders continued to speak of global responsibilities, of maintaining a presence east of Suez, of upholding sterling as an international currency. The rhetoric persisted even as the economic foundation crumbled. This gap between rhetoric and reality imposed real costs. Resources that could have been invested in domestic modernization were instead spent maintaining overseas bases. Capital that could have funded industrial restructuring was instead used to defend the pound's value through intervention in currency markets. The opportunity cost was substantial. By the 1970s, the transformation was complete. Britain was no longer a reserve currency power. It was a middle-sized European economy, dependent on IMF support and subject to external conditions on its domestic policies. The transformation had taken 2 decades, but the critical moment was Suez. The United States currently operates a reserve currency system structurally similar to Britain's in the mid-20th century. The dollar serves as the global medium of exchange, the primary reserve asset, and the pricing standard for commodities. This position provides substantial benefits: the ability to borrow at lower interest rates than fundamentals alone would justify, the capacity to run persistent current account deficits without immediate crisis, and the power to use financial sanctions as a foreign policy tool. But the foundation supporting this system shows specific parallels to Britain's deteriorating position. The United States has run current account deficits continuously since the 1970s, accumulating foreign liabilities that now exceed $30 trillion. The federal government debt exceeds 120% of GDP and is projected to rise. Net international investment position, assets owned abroad minus liabilities owed to foreigners, has been negative since the 1980s and continues to deteriorate. The reserve currency status persists despite these imbalances because of network effects and institutional inertia. Global trade infrastructure is built around the dollar. Central banks hold dollars because other central banks hold dollars. The system is self-reinforcing, exactly as the pound system was in the early 20th century. The structural vulnerability is identical to Britain's. As long as confidence in American institutions and the dollar's stability remains intact, foreign holders will continue accumulating dollar assets despite the underlying imbalances. But confidence, once broken, cannot be easily restored. Certain developments suggest the network effects are weakening. China and Russia conduct bilateral trade in their own currencies, reducing dollar dependence. The BRICS nations have established alternative payment systems. Even allied governments are discussing reserve diversification. These changes are gradual, but the direction is consistent. The parallel extends to policy responses. Just as Britain maintained global military commitments beyond its economic capacity, the United States operates military bases across the world while running fiscal deficits. Just as Britain used colonial arrangements to enforce sterling as an international currency, the United States maintains the petrodollar system, though this too shows signs of erosion. The question is not whether this system can continue indefinitely, no reserve currency has, but whether the transition will be managed or chaotic. Britain's transition was chaotic because British leaders refused to adjust their commitments to match their economic capacity. The same choice faces American policymakers.
The British pound's collapse as a reserve currency was not caused by external enemies. It resulted from domestic policy choices. The choice to maintain an artificially valued currency. The choice to fund current consumption through debt rather than investment in productive capacity. The choice to prioritize global military presence over domestic economic strength. The choice to preserve the appearance of power rather than the substance. These choices created imbalances that compounded over time. Debt service costs grew. Industrial capacity stagnated. Trade deficits persisted. The gap between Britain's actual economic strength and its currency's global role widened. When stress arrived, when creditors questioned Britain's financial sustainability, the system collapsed rapidly because the foundation had been eroding for decades. The pattern repeats throughout monetary history. Reserve currencies fail when the gap between perception and economic reality becomes unsustainable. The failure appears sudden, but the structural deterioration occurs over years. The lesson is not that American decline is inevitable. It is that specific policy choices produce specific outcomes. Persistent deficits funded by reserve currency privilege create dependency on foreign creditors. That dependency becomes a vulnerability. When creditors lose confidence, the ability to run deficits ends abruptly. Britain's Suez moment arrived when its creditor decided British policy conflicted with creditor interests. The timing was specific to that circumstance, but the mechanism is general. Any debtor nation is vulnerable to creditor pressure. Reserve currency status delays the reckoning, but does not eliminate the underlying mathematics. The question facing any reserve currency power is whether it will use its privileged position to build genuine economic strength or to postpone necessary adjustments. Britain chose postponement. The cost was a chaotic, disruptive transition that could have been managed more effectively through earlier action. The same choice exists today. History does not determine outcomes, but it does reveal mechanisms. The mechanism by which reserve currencies fail is well documented. Whether this knowledge produces different decisions remains to be seen.